Welcome to the Intelligent Investing Podcast, where modern portfolio theory can suck it. A student of the School of Graham and Doddsville and a clergy member of the Church of Warren Buffett. Here's your host, Eric Schleien.
Hi, this is Eric Schleien. You are listening to the Intelligent Investing Podcast. Today we have back on DTEJD 1997. Welcome back to the show.
Hey, Eric. Thank you so much for having me. It's an honor. I appreciate it.
Absolutely. So I want to talk about Meritage Hospitality today.
Sure.
Now, are you a shareholder in the company?
I currently am not a shareholder. It's one of my many stupid mistakes. I used to be, and I had maybe a 4x gain in it, and I sold out because I was so happy to book a gain, and that was at about little over $6 a share. And today it's gone back down, but the interesting thing is I sold, I think, I don't know, maybe 3 years ago or so. But there have been a couple of interesting factors that are causing me to come back and reevaluate it and take another look at it.
Well, let's first hold that thought for a second. Why don't you explain to the listeners what the company even is, for those who aren't familiar?
Okay. Good point, yes. Well, Meritage Hospitality is primarily a restaurant company, and they own and operate restaurants. And their main operations is being a franchisee of Wendy's. And I think they are the second largest franchisee of Wendy's. They have approximately 317 restaurants in 16 different states. And most of their operations are in the Midwest and South, although they have some in Texas and they have some in the Northeast. But it's primarily the Midwest and the South. Now, most of their restaurants are Wendy's, but they do have some of their own internal brands. But Wendy's is probably 85 to 90% of their sales at this point. So that's basically the company, but it's not 100%. But if you are buying into Meritage, you're primarily getting a Wendy's operation.
And why buy a company that owns Wendy's versus just buying Wendy's stock outright?
Well, good question.
Isn't it generally, from my understanding, that if you're a franchisee, it's typically slightly worse of a business because you're paying those royalties to the company?
Well, yes, generally you're correct, but there can be valuation differentials.
Sure.
For example,
go ahead.
So to answer your question, yes, you are generally correct, but not 100% of the time. Now, I can't say this for sure because I don't have Wendy's information in front of me, but Meritage currently is trading for a PE of approximately 8. And I'm going to guess that Wendy's is quite significantly more than that. Now, of course, Wendy's, being the franchisor, generally speaking, is, a better position than being the franchisee. But like I said, there are a few interesting things about Meritage that make it a little bit different and may make it a more compelling investment situation.
I just did look up Wendy's. It's about 9.5 right now, PE.
Oh, really? Oh, wow. Okay.
That was just from the Google numbers, so those could potentially be wrong, but that was just a 30-second quick look. Right. But go ahead.
Well, one of the interesting things. Okay, so let me get into the meat of the situation here. Way back when, this is probably maybe 10 years ago or so, I bought into Meritage just after the great financial collapse. And I picked up my shares for under $1.50 a share.
And how did you discover the business?
Well, Meritage is headquartered in Grand Rapids, Michigan, and that's where I went to Grand Valley State University for undergraduate.
That's a fun place too.
Yeah, I love Grand Rapids. That's a wonderful city, and the west part of Michigan is just wonderful. It's a great place to be.
I think their representative in Congress probably is the best congressman in the United States.
Could be
Justin Amash.
Yes, arguably.
I love him.
For sure.
Anyway, this is not a political show, but go ahead.
Yeah. So I've known about them for, I don't know, 25 years or so. And way back when, they used to own hotels and resorts in addition to restaurants, but they got rid of all the hotels and resorts to focus, exclusively on the restaurants. So I heard about it on the internet in a discussion group and took a look at it and thought, oh yeah, this looks pretty good. They're starting to make money. And one of the things they're doing, Eric, and this is what I find quite interesting and could put them in a good position, is that Wendy's, the franchisees of Wendy's are typically widely scattered and a quite diverse group, in that most of the franchisees of Wendy's own, 1, 2, 3, 4, 5 locations. You don't have, like 4 companies owning 400 locations each. So it's quite a fragmented franchisee base. And one of the things that Meritage has been doing, and they've been doing this quite successfully for maybe 8 years now, 10 years, is that they go in and they buy out these small operators, that have a handful of Wendy's locations. And there's a couple things that are going on that act as a catalyst that Meritage can get in there. Is number one, a lot of the franchisees have owned them for 15, 20, 30, 40 years even, and they're hitting retirement age. So they are looking to sell out. And when they're selling out, they're selling for about, 4 times cash flow, sometimes 3.5, sometimes 5 times. But typically they're selling, their franchise for a very low cash flow. So Meritage is acting as a roll-up for all of these fragmented Wendy's.
And do they buy them in cash, or do they borrow money to buy these Wendy's?
Both, but primarily they're primarily borrowing, and that is one of the downsides, I think, is they have a little bit more debt than what I typically like to see, but it's nothing outrageous.
Why do you see that as a downside, especially in a low interest rate environment? If you could borrow money and buy an asset at 4 times cash flow, isn't that a pretty good value proposition? Like I don't see Wendy's as a super risky asset. I mean, tell me if I'm wrong, but
that it is. But when there is risk, who knows? There could be, a rat drops out of the ceiling at Wendy's in Comstock Heights, Michigan, and makes national news. I think that actually happened with a Chipotle in Boston that out of the ceiling or something like that. Right. So there is some amount. Yeah, I think it's low risk, but there is some amount of risk. I mean, in an ideal world, the company wouldn't have any debt, but
that's debatable. That's debatable.
Well, okay. So they do have some amount of debt, and they've been borrowing money to roll up these franchisees for the past decade. And when they take out a 2-unit operator, they also get some quality improvements and some efficiencies. Because if your back office only has 2 or 3 restaurants versus 300, you don't have the efficiencies that Meritage has built in.
That's a good point. That's a very good point.
Yeah. So typically, they can increase the quality a little bit, and they increase the margins a little bit. So
now, really, even though they're buying it at 4 times cash flow, there's some synergy. So they they can increase those margins a little bit.
Yeah, a little bit. Yes. Now, the other catalyst that is enabling Meritage to come in and acquire some of these franchisees is that Wendy's is having a big, they have some corporate speak for it, but they are upgrading and rejuvenating their restaurants. They're putting in free Wi-Fi, large screen TVs. They're updating the exterior facade of the restaurant.
Did I lose you? Are you there?
I'm here.
All right, we lost him for a second. So the last thing we heard you say was they were upgrading the restaurants. We'll edit that gap out. Not a big deal.
Okay.
Okay. So you're saying they're upgrading the restaurants and go from there.
Yeah. Okay. Upgrading the restaurants, both on the interior and the exterior facade, and this can cost easily $1,000 per location. So some of the franchisees say, well, I've had a good run with Wendy's, but I don't want to invest the capital to bring my restaurants, up to a modern standard. So Meritage steps in and they buy them out, and then they upgrade. They upgrade the facility. And so this has worked quite well for Meritage, and they are increasing their restaurant fleet and they're increasing their sales. I think last year their sales were up like 22% corporate wide because of the efficiencies in buying new restaurants. So one of the reasons, going back to why you might prefer Meritage over Wendy's, is that Meritage is growing their sales and earnings much higher clip than what the Wendy's Corporation is.
Interesting. That's a pretty straightforward idea.
Yeah, it is, and they've executed. I mean, they haven't executed perfectly. I would probably give management a B+, A- on their roll-up plans for Wendy. So they're pretty good. They're pretty good.
Okay, so what has them not be great? Where do you feel like the management's lacking?
Well, they don't always, hit their numbers every quarter, but then to also be fair, sometimes they exceed them. So it's just the, kind of the normal variations in business.
Long term, though, I mean, have they done pretty okay?
Oh yeah. Well,
because I don't know. I mean, if they're not making numbers quarter to quarter, I don't necessarily see that as a bad thing if they're just not focused on a quarter to quarter basis.
Well,
right?
Yeah, and I'm kind of being a little nitpicky here,
That's
but
okay.
I mean, yeah, they've grown they have earnings of approximately $2.10 a share for the trailing 12 months. So over the past decade, when you look at it, year to year, on a year-to-year basis, generally speaking, they've done a very, very good job of growing sales, growing earnings, growing cash flow, growing the number of restaurants that they have. So yeah, they get very high marks there, for sure. But they do have about $35 million worth of debt at the corporate level. So that's, I don't think that's a problem, but, if we were to go into another great recession, and the credit markets get turned off, who knows? That could be a problem.
It could be an issue.
I don't think that it is, but there is one very, very interesting thing about Meritage that may make it a very, very compelling investment, and that is they still have 765 acres of undeveloped land in Eleutheria, the Bahamas, and I think that this was or is the last remnant of their resorts and hotels division. And this land has been for sale for, I think, at least 10 years. And in October of 2018, they reached an agreement in principle to sell it to the Disney Cruise Line as a disembarkation point for their passengers, on the Disney cruise ships. So, the Disney cruise ships will come in, they let the passengers off and they, go swimming or eat or, just have a fun time down in the Bahamas on this, 700 acres of land. So a sale price, unfortunately, was not disclosed, but I'm going to guess that they're probably... Okay, so where...
You were saying they didn't disclose the sale price. Just start from there.
Okay, so Meritage has reached an agreement with Disney to sell this land down in the Bahamas, and unfortunately, they have not disclosed the sale price, but it is 765 acres of prime resort area land. So, if that land is worth, say, $100,000 an acre or $50,000 an acre, you can do the numbers, and that's going to be, I think, quite significant to the market cap of Meritage, which is just over $100 million. So this could be a very nice little liquidity event for Meritage in that they sell off this land to Disney.
So why don't you own stock?
Just foolishness. When I sold it way back when at, about $6.50 a share, it just proceeded to keep going higher and higher and higher, and I kind of stopped paying attention to it. But I've started paying attention to it now that they announced that they are selling the Bahamas land.
Interesting. And then what are they gonna do with that cash? Are they gonna buy more Wendy's with it or give it back to shareholders?
Well, I think they're primarily going to buy more Wendy's with it and keep expanding the company. Now, Meritage does pay dividends, but they pay them in the form of usually special dividends. So I would also expect that they're going to increase their special dividends. But the dividends, generally speaking, have been pretty small. The stock's yielding about 1% or so. So I would expect them to increase the dividend with the sale of the land, but I think they're going to take most of that money and continue to buy Wendy's. And my guess is that they'll continue buying Wendy's for the foreseeable future, but at some point they will run out. Can they go from 300 to 500 restaurants? Yeah, probably. But are they going to go from 300 to 1,000 Wendy's? I'm not so sure, because at some point Wendy's may say, we want, we don't want one company buying up all of the franchisees. So at some point they're going to run out of Wendy's to purchase. And I think when that happens, then they'll probably focus on their internal brands and then also paying down of the debt and, fortifying the balance sheet. So
it's an interesting model.
It is, and they've been very successful with it.
I was going to say, if they can pull that off and kind of maximize their Wendy's expansion, it could be a decent investment.
Oh, absolutely. And, the stock's earning a little over $2 a share today. In 4 or 5 years, could they be earning $4 a share? I think they absolutely could.
Especially if they're buying Wendy's at 4 times free cash flow.
Well, 4 times EBITDA, yeah.
Okay.
Yeah, I don't know that that's free cash flow because they have to frequently, put it back into the restaurant. But they are getting them at pretty good valuations.
Interesting.
So, as always, your listeners should do their own due diligence and simply not rely, just use this as a jumping off point to say, oh, well, that does sound interesting. I'm going to investigate it further. But with that sale of the land down in the Bahamas, that could be that could provide a nice little spike to the share price when that is finalized. So it's an interesting company, and I did well with them, and unfortunately I sold out way too soon, but I guess you never go broke taking a profit.
Let's say that's a high class problem.
Yes, I wish I had that problem all the time.
Don't we all? All right, well, that was interesting. Anything else you want to add before we wrap up?
No, just thank you so much for having me on the show, and I appreciate it as always, Eric.
Absolutely, my pleasure.
You.
Yeah, well,
of
course. Have a great day.
Okay, you too.
All right, take care.
Thank you for listening to the Intelligent Investing Podcast with Eric Schleien. If you'd like to connect with Eric for questions, comments, feedback, ideas, or to inquire about being on the show, please contact Eric at intelligentinvesting@gmail.com. So, in the words of Charlie Munger, I have nothing to add.